Imagine watching a currency pair suddenly punch through a heavy resistance level. The candlestick shoots up to a thrilling new high, and thousands of retail traders rush to hit the buy button. Within minutes, that upward momentum evaporates. The price snaps violently back down, blowing past stop losses and leaving late buyers trapped in deeply negative positions. The problem here is the dataset. Staring strictly at price action only tells you where the market has already traveled. It offers absolutely zero data on the financial weight driving that movement. Often, the market is simply fishing for liquidity. Institutional players will briefly push the price upward to trigger pending buy orders, creating artificial movement with no structural support behind it. Relying on the candlestick chart alone leaves you reading an incomplete story. Price dictates the surface direction, but it actively conceals the true intentions of the market's largest institutional participants. To measure the actual conviction behind a market move, you have to measure volume, the raw amount of capital flowing in or out of a position. But unlike the stock market, where every share traded is tallied on a centralized exchange like the NYSE, the Forex market is entirely decentralized. There is no central clearinghouse keeping a global ledger of every single currency trade. To bridge this gap, currency traders use a proxy called tick volume. This measures the number of times the price changes within a given period, serving as a rough estimate of market activity. Raw tick volume is just a chaotic stream of data. Until you can translate those invisible fluctuations into a clear, readable signal, you are largely guessing against traders who already know where the money is flowing. Stock market analyst Marc Chaikin developed a specific mathematical tool to solve this exact problem, the Chaikin Oscillator. It operates as an indicator of an indicator. Instead of measuring the currency price directly, it tracks the momentum of the Accumulation Distribution Line, or ADL, a metric that combines price closing levels with volume. This chart splits the ADL into a fast 3-day and slower 10-day moving average. The difference creates a single continuous wave. Pushing above the center zero line means buying pressure dominates as institutions accumulate. Dropping below zero signals major players are offloading positions. By turning abstract volume into a simple positive or negative reading, you have a direct method for identifying whether heavy capital is actually backing the current trend. The oscillator's true utility shines when the visual illusion of the price chart directly contradicts the mathematical reality of the volume. Traders call this divergence. Here we see bullish divergence. The top candlestick chart drops to a lower low, while the oscillator below prints a higher low. Drawing trend lines across these lows shows them moving in opposite directions, proving the selling pressure is running out of steam. Bearish divergence is the exact reverse. The price pushes to a new higher high, but the oscillator sinks to a lower high. These splitting trend lines sound an alarm that the current rally is empty and a reversal is imminent. By tracking these contradictions, you gain the ability to spot the exhaustion of a trend long before the candlestick chart reflects the change in direction. For all its utility in exposing hidden volume, no professional trader relies on the Chaikin Oscillator entirely on its own. The tool is highly specialized. You use the oscillator exclusively to confirm the why behind a market move, but you still need traditional price-based indicators, like the 200-period exponential moving average, to define exactly where it is safe to execute an entry. A strict mechanical filter keeps you out of risky setups. For example, you should only act on a bullish divergent signal from the Chaikin Oscillator if the currency price is already sitting safely above the 200 EMA. Layering your indicators like this permanently ties your volume analysis to the long-term structural trend, systematically stripping out dozens of false signals in sideways markets. Reacting blindly to the flicker of the price action creates a stressful cycle of buying at the top and selling at the bottom. Translating tick volume gives you a direct line into the actual mechanics of the market, turning invisible institutional behavior into a clear, predictive roadmap. Open up a demo chart today, attach the Chaikin Oscillator below your favorite currency pair, and start scanning for those hidden moments of divergence. By shifting your focus from the surface of the price to the engine of the volume, you stop falling for market traps and start